Growth ETFs or dividend ETFs. It is the most argued debate in personal finance right now, and both sides are convinced they are correct. We ran 20 years of actual return data, and the answer is more complicated than either camp wants to admit. Before the numbers, one distinction needs to be settled up front because the entire comparison hinges on it. The question is not which ETF earns a higher return on a spreadsheet. The question is, which one makes the investor who actually holds it richer after 20 years? Those are two different questions, and the gap between them is where most of these comparisons completely break down. Defining the contestants. The growth ETF used in this comparison is QQQ, the Invesco NASDAQ 100 ETF. QQQ holds the 100 largest non-financial companies listed on the NASDAQ exchange, weighted by market capitalization. Its top holdings as of 2024 are dominated by Apple, Microsoft, Nvidia, Meta, and Amazon, which together represent a significant concentration in technology and technology-adjacent businesses. QQQ pays a minimal dividend, currently yielding less than 0.6% annually, because its underlying companies reinvest most earnings back into growth rather than distributing cash to shareholders. Its expense ratio is 0.20% per Invesco's fund prospectus. The dividend ETF representative is VYM, the Vanguard High Dividend Yield ETF, launched in November 2006. VYM holds approximately 550 large-cap U.S. companies that pay above-average dividend yields relative to the broader market, weighted by market capitalization. Its expense ratio is 0.06% per Vanguard's fund prospectus, significantly lower than QQQ. Unlike QQQ, VYM is specifically constructed to deliver current income, currently yielding approximately 2.8 to 3.2% annually, with dividends paid quarterly to shareholders. The 20-year total return math. Over the 20-year period from approximately 2004 to 2024, QQQ delivered an annualized total return of approximately 14.7%, including the reinvestment of its minimal dividend, according to Invesco performance data and Morningstar historical records. VYM launched in 2006 and has delivered approximately 9.5 to 10.5% annualized total return since inception through 2024 per Vanguard's published fund performance figures. On a $10,000 initial investment, QQQ at 14.7% annualized for 20 years grows to approximately $143,000. A dividend ETF equivalent at 10% annualized for 20 years grows to approximately $67,000. On a $100,000 starting investment, QQQ produces roughly $1,430,000, while the dividend ETF equivalent produces roughly $670,000 over the same period. The growth ETF wins the 20-year total return comparison by a substantial margin, and that fact should be stated clearly before any qualifications are added. But here is what that clean number leaves out entirely. What the total return number does not show. QQQ lost approximately 83% of its value between March 2000 and October 2002 during the dot-com collapse. An investor who put $100,000 into QQQ in early 2000 watched it fall to approximately $17,000 before it began recovering. QQQ did not return to its pre-crash highs until 2015, more than 15 years after the peak. A dividend ETF holding quality, large-cap dividend-paying companies lost approximately 30 to 40% in the same crash and recovered significantly faster because its underlying companies continued generating and distributing real cash earnings throughout the downturn. The 2008 financial crisis produced a similar divergence. QQQ fell approximately 50% peak to trough. A dividend-focused portfolio fell roughly 40% over the same period. The 2022 bear market saw QQQ decline over 32%, while dividend-focused funds, including SCHD, held up with considerably smaller losses due to the quality and cash flow orientation of their underlying holdings. These drawdowns are not footnotes to the 20-year return story. They are the test that determines whether the investor who started the journey actually finished it. An investor who panicked and sold QQQ near the bottom of the dot-com bust did not capture the 14.7% annualized return. They captured a permanent loss. An investor holding VYM through the same period continued receiving quarterly dividend payments throughout the crash, which provided both real income and a psychological anchor that made staying invested significantly easier. The income comparison, VYM, at a 3% yield on a $100,000 portfolio generates approximately $3,000 per year in dividend income that arrives in the investor's account regardless of whether the market is up or down. QQQ at 0.6% generates approximately $600 per year from the same invested amount. That difference of $2,400 per year in annual cash income arrives from the same capital without any shares needing to be sold. For an investor in retirement who needs to fund living expenses from their portfolio, this distinction matters enormously. Withdrawing from a portfolio that is simultaneously falling in value forces the investor to sell shares at depressed prices. Those sold shares cannot participate in the eventual recovery. This dynamic, known in financial planning literature as sequence of returns risk, represents one of the most significant practical arguments for dividend-focused investing, specifically for investors who are at or near the point where they need their portfolio to generate spending money. Dividend income arrives without reducing the share count, which means a meaningful portion of living expenses can be covered without locking in losses during market downturns. The tax and behavioral dimensions. VYM and comparable dividend ETFs pay predominantly qualified dividends taxed at the lower long-term capital gains rate of 0 to 20%, depending on income bracket per current IRS tax schedules. QQQ's growth compounds largely untaxed inside the fund until the investor sells, at which point long-term capital gains tax also applies. For a tax-advantaged account like a Roth IRA or 401k, this distinction disappears. For a taxable brokerage account, the growth ETF's deferral of taxation until sale is actually an advantage since no annual dividend tax drag reduces the compounding base each year. The behavioral dimension may be the most underestimated factor in this entire comparison. Research published in the Journal of Behavioral Finance has documented that investors who receive regular dividend payments demonstrate measurably better long-term holding behavior than investors in pure growth funds, because the quarterly income creates a tangible sense of progress that reduces the emotional pressure to sell during market declines. An investor who holds QQQ through 3 significant drawdowns over 20 years and never sells captures the full 14.7% annualized return. An investor who exits at the bottom of any one of those drawdowns does not. Dividend income does not change the math of the fund, but it changes the behavior of the investor who holds it. The honest verdict. On pure total return over the last 20 years, QQQ wins by a wide margin. That is the correct reading of the historical data, and any comparison that avoids stating it directly is incomplete. The more complete answer is that QQQ's superior return came with approximately double the volatility and drawdown depth of a dividend ETF approach and required the investor to hold through the worst crashes in modern market history without selling. Investors who are 30 or more years from retirement hold their investments inside a tax-advantaged account and have demonstrated through prior experience that they can hold through 50% declines without selling are genuinely better positioned in a growth ETF based on the historical data. Investors who are within 10 years of or already in retirement need current income without selling shares or know from experience that large drawdowns create emotional pressure to exit the market are better positioned in a dividend ETF where the income stream provides both practical cash flow and the behavioral stability to stay invested through downturns. The highest total return on paper and the highest actual wealth accumulated by a real investor are only the same number if the investor holds the entire time without selling. For many people, they are not. Total return on a chart is not the same as wealth in your account. The fund with the better historical number means nothing if the investor holding it exits during a crash and never gets back in. Understanding your own investing behavior as clearly as you understand a fund's historical return is the most important calculation in this entire comparison. If this breakdown helped you think through which approach actually fits your situation, subscribe because every week we run the real numbers on the investment decisions that millions of people are making without seeing the full picture.